Good morning, students. I'm Dr. Ramadevi, Assistant Professor of Economics Department. So, students, in the previous classes, we have clearly discussed about what is financial economics and what is money supply and what are the features of money supply, what is money market, like that. We have discussed some different topics in the previous classes, right? Today, let us concentrate on the banking system in India. So, the banking system in India supervises as well as administers exchange control and banking regulations as well as it administers the government's monetary policy. And if you see this banking system in our country, it works according to the guidelines which is issued by the Reserve Bank of India. So, this banking sector is the lifeline of all the modern economy. Then let us concentrate on the evaluation of Indian banking. So the evaluation of Indian banking system has been classified into three types. One is pre-independence period, that is 1786 to 1947. Second one is post-independence period, that is 1947 to 1991. And the third one is liberalization period, that is during 1991 to till date. First, let us concentrate on the pre-independence period, that is 1786 to 1947. The first Bank of India was the Bank of Hindustan. Actually, this Bank of Hindustan was established during 1977. And it was located in the pan-Indian capital, that is Calcutta. However, this bank failed to work as well as it ceased operations during 1842. So during the pre-independence period, over 600 banks has been registered in the country, but only a few countries, only the few banks managed to survive, right? The main part of this the Bank of Hindustan, the various other banks also established in India. So during 1786 to 1791, we have introduced the General Bank of India. Again, during 1881 to 1958, we have introduced the Commercial Bank. During 1809, we have introduced Bank of Bengal. Again, in the year 1840, we have introduced this Bank of Bombay. Then Bank of Madras has been introduced during 1843. So during the British rule of India, the East India Company has established three banks. One is Bank of Bengal, second one is Bank of Bombay, and the third one is Bank of Madras. So, and these are called as the presidential banks. So, these three banks are later managed into one single bank during 1921. So, it was called as Imperial Bank of India. So, the Imperial Bank of India was later nationalized during 1955. It was named the State Bank of India, which is currently the largest public sector bank, right? Now, we can see some list of other banks which were established during pre-independence period. Allahabad Bank established during 1865. Then in the year 1894, Punjab National Bank introduced. 1906, Bank of India established. During 1911, Central Bank of India established. During 1906, again Canara Bank established. Then during 1908, Bank of Baroda introduced. So if we talk of the reasons as to why many banks failed to survive during this pre-independence period, the conditions are: Indian account holders had become fraud. At the same time, lack of machines as well as technology, human errors, time consuming, fewer facilities, a lack of proper management skills. These are the main reasons why our major banks failed before independence. Then let us concentrate on post-independence. That is 1947 to 1991. So at the time when India got independence, all the major banks of our country were led privately, which as a cause of concern as the possible belonging to rural areas were still dependent on moneylenders for financial assistance. So, with the aim of solving these problems, the then government decided to nationalize the banks. So, these banks were nationalized under the Banking Regulation Act 1949, whereas the Reserve Bank of India was nationalized during 1949. So these formation of State Bank of India during 1955 and the other 14 banks also nationalized between the time duration 1969 to 1991. So these were the banks whose national deposits was more than 50 crores, right? Now let us see what are the banks nationalized during 1969. So these are the banks: Allahabad Bank, Bank of Baroda, Bank of India, Bank of Maharashtra, Central Bank of India, Canara Bank, Dena Bank, Indian Overseas Bank, Indian Bank, Punjab National Bank, Syndicate Bank, Union Bank of India, United Bank, UCO Bank. These are the banks which was nationalized during 1969. Then during the year 1980, again another six banks were nationalized. That is Andhra Bank, Corporation Bank, New Bank of India, Oriental Bank of Punjab and Sind Bank, Vijaya Bank. These are the banks nationalized. Then some subsidiaries to State Bank of India also nationalized during 1959. So these subsidiaries banks are State Bank of Patiala, State Bank of Hyderabad, State Bank of Jaipur, State Bank of Mysore, State Bank of Travancore, State Bank of Maharashtra, State Bank of Indore. So all these banks later merged with State Bank of India during 2017. So except the State Bank of Maharashtra, other banks merged during 2017, right? Then let us concentrate after liberalization period, that is after 1991 till today. We will discuss clearly. So once the banks were established in our country, regular monitoring as well as the regulations needs to be followed to continue the profits provided by the banking sector. So the last phase or the ongoing phase of this banking sector development plays a hugely significant role. So to provide stability as well as profitability to the national public sector banks, the government they have decided to set up a committee under the leadership of Sri Narasimhan. The main purpose of this committee is to manage the various reforms in the Indian banking industry. So the biggest development was the introduction of private sector banks in India. So the Reserve Bank of India, they gave license to 10 private sector banks also because they want to establish themselves in the country. So these banks are Global Trust Bank, ICICI Bank, HDFC Bank, Axis Bank, Bank of Punjab, Bank, Centurion Bank, uh, IDBI Bank, Times Bank, as well as Development Credit Bank. Then let us clearly discuss about the banking structure in India. See, the structure of the banking system in India is concerned, it has been broadly classified into three types. One is scheduled bank, second one is non-scheduled bank, and the third one is a development bank. So banks that are included in the second schedule of the Reserve Bank of India Act 1934 are considered to be the scheduled banks. See, normally the scheduled banks are concerned, such a bank becomes eligible for debts as well as loans on bank rate from the Reserve Bank of India. So such a bank automatically acquires the membership of a clearing house, right? So all the banks which are not at all included in the second section of Reserve Bank of India Act 1934 are considered as a non-scheduled bank. So they are not at all eligible to borrow from the Reserve Bank of India for normal banking purposes except for emergencies. These scheduled banks are further divided into two. One is commercial bank and the another one is cooperative bank. First, let us concentrate on these commercial banks. So, the institutions that accepts deposits from the general public and advances loan with the purpose of earning profits are normally considered as a commercial bank. So, these commercial banks again divided into four types. One is public sector banks, second one is private sector bank, third one is foreign banks, and the fourth one is regional rural banks. Now let us discuss about the public sector banks. See, normally these public sector banks are the majority stake is held by the government. So after the recent amalgamation of smaller banks with the larger banks, there are 12 public sector banks in India as of now. So an example of this public sector bank is State Bank of India. And if we concentrate on these private sector banks, these banks are where the major stocks in these equity are owned by these private stakeholders or business houses. So a few major private sector banks in India are HDFC Bank, ICICI Bank, and then we will concentrate on these foreign banks. So a foreign bank means it has its headquarters outside the country, but it runs its offices as a private entity at any other location outside our country. So such banks are under an obligation to prepare under the regulations provided by the central bank of the country as well as the rule prescribed by the parent organization located outside the India. So the best example for this foreign bank is foreign bank in India, that is the Six Bank, right? Then let us move to this regional rural bank. So these regional rural banks were established under the Regional Rural Banks Ordinance 1975. The main aim of these regional rural banks are to ensure the sufficient institutional credit for agriculture as well as other rural sectors. So the area of operations of these RRB, that is the regional rural banks, are very limited to the area which is notified by the government, right? So these RRBs are generally owned jointly by this government of India, the state government, and sponsor banks. An example of these RRB in India is Arunachal Pradesh Rural Bank. Then let us concentrate on these cooperative banks. See, a cooperative bank is a financial entity that belongs to its members who are also the owners as well as the customers of their bank, right? So these cooperative banks are providing their members with some numerous banking and financial services. These banks are primary supporters to the agricultural activities, some small scale industries as well as self-employed workers also. So the best example is Maharashtra Urban Cooperative Bank. So at ground level, the individual persons come together to form a credit cooperative society. The individual in this society include an association of borrowers as well as non-borrowers residing in a particular locality and talking and taking interest in the business affairs of one another. So, as membership is practically open to all inhabitants of a locality, people of different status are brought together into a common organization. So, all the societies in an area come together to form a central cooperative banks. Then let us concentrate on cooperative banks. So these cooperative banks are further divided into two categories. One is urban and another one is rural. So these rural cooperative banks are either short-term or long-term. Short-term cooperative banks are again subdivided into state cooperative banks, district central cooperative banks, primary agricultural credit societies. At the same time, long-term banks are either state cooperative agriculture or rural development banks or subsidiary cooperative agriculture and rural development banks. So urban cooperative banks mean to primary cooperative banks located in urban as well as semi-urban areas. Then if you look about these development banks, these are some financial institutions. These provide long-term credit because they want to create some support to capital-intensive investment spread over a long period and yielding low rates of interest with considerable social benefits. These are considered as a development bank. The main development banks in India is Industrial Finance Corporation of India, 1948, Industrial Development Bank of India, Export Import Bank of India, Small Industries Development Bank of India, National Bank for Agriculture and Rural Development. So these banking system of our country has the capacity to heavily influence the development of a country's economy. So it is also instrumental in the development of rural as well as the urban regions of the country as it provides the capital for small businesses and helps them to grow their business. Right? Now let us concentrate on these recent developments in Indian banking sector. First recent development is digitalization, mobile banking, UPI, that is the Unified Payment Interface, blockchain, artificial intelligence robots, fintech companies as well as digital only banks. So these are the important aspects we have discussed in the this talk. Thank you, students.